Pump and dump schemes. Probably the most famous market manipulation is pump and dump. Scammers find a thinly traded, low-priced stock, generally a penny stock, with little daily trading activity. They then create excitement artificially. This can happen through huge email campaigns, internet forums, chat rooms, YouTube videos, or bogus research reports predicting massive growth. Always promises assured profits, secret insider information, and urgent recommendations to buy before it's too late. More naive investors buying raises the price due to rapid demand. Once the stock peaks, scammers sell all their shares for a great profit. After that, the stock drops, frequently plummeting lower than before, and hype buyers lose a lot. The internet has boosted this decades-old swindle. This method has controlled entire internet communities without their knowledge, confirming its effectiveness. Insider trading is when people with confidential, non-public information about a company use that knowledge to buy or sell shares before the information is announced. For example, imagine an executive knows that their company is about to announce a merger that will skyrocket the stock. If they quietly buy shares beforehand, they lock in guaranteed profits when the news goes public. This type of activity is illegal because it creates an uneven playing field. Regular investors only see the news when it's public, while insiders profit unfairly. Some of the most famous scandals in finance history, like the cases involving Enron and Martha Stewart, revolved around insider trading. Regulators like the SEC constantly monitor unusual trading patterns to catch insiders. But because it can happen in subtle ways, like tipping off friends or family, it remains a persistent problem in financial markets. Wash trading. Wash trading is another deceptive tactic where the same person or group simultaneously buys and sells the same stock over and over. On the surface, this makes it look like there's huge demand because trading volume spikes. Other investors see the activity and assume something big is happening. Naturally, they jump in, thinking they've spotted a hot trend. In reality, the trades cancel each other out, and the activity is entirely fake. Wash trading was common in the early days of the US stock market before it became illegal, but it still shows up in unregulated spaces today. Cryptocurrency markets, for instance, are often accused of wash trading to make certain coins look more popular than they actually are. It preys on investors' natural instinct to follow momentum without questioning if it's real. Spoofing and layering. Spoofing is a form of high-tech trickery where traders place massive orders to buy or sell but cancel them before they're ever executed. These fake orders give the impression of huge demand or overwhelming supply. For example, if a spoofer places a giant buy order, it can trick others into thinking the stock is about to surge. Traders rush in, pushing the price up. Then, the scammer cancels the fake order and sells at the higher price. Layering is similar, except multiple levels of fake orders are stacked across different price points, making the illusion even more convincing. Both strategies exploit the speed of modern markets, especially algorithms that react to order books within milliseconds. These schemes are banned, and regulators have fined major banks and hedge funds for using them. Still, because the orders disappear so quickly, spoofing is one of the hardest scams to fully police. Stock promotion scams. A newer and more subtle scam involves fake promotions disguised as advice. Scammers pay influencers, bloggers, or so-called financial gurus to hype up a stock. The promotion might appear as a glowing YouTube review, a TikTok tip, or a newsletter claiming the stock is the next big thing. On the surface, it looks like legitimate research, but behind the scenes, the person giving the advice is being paid, often with shares they want to unload. By the time retail investors buy in, the promoters dump their shares, leaving everyone else holding the bag. This is essentially a pump and dump with a modern twist. Instead of cold calls or spam emails, scammers use social media influencers and content creators. It's dangerous because the line between genuine enthusiasm and paid promotion is often blurred, making it hard for everyday investors to tell the difference. Short and distort. If pump and dump inflates prices, short and distort pushes them down. Here, scammers take short positions, betting that a stock will fall. Then, they spread damaging rumors, misleading reports, or false news about the company. They might claim the company is under investigation, faking financial results, or about to go bankrupt. Fear spreads quickly, especially online, and investors panic sell. As the price drops, the scammers close their short positions at a profit. While short selling itself is a legal and important part of healthy markets, short and distort scams rely on deception. Some companies have even accused activist investors of crossing this line, using exaggerated or misleading claims to profit. The problem is that by the time the truth comes out, the stock price and reputation of the company may already be severely damaged. Boiler room operations. Boiler rooms are the stuff of Hollywood movies, but they're based on real scams. Imagine a room full of salespeople making hundreds of cold calls a day. Using aggressive scripts, they convince unsuspecting investors, often retirees or beginners, to buy shares in obscure, worthless companies. The salespeople are trained to create urgency, dropping lines like, "You'll miss out if you don't act now," or "Insiders are already loading up." These operations were especially rampant in the 1980s and 1990s, and they still exist today in slightly different forms. Once the scammers sell enough worthless shares to their victims, the price collapses and the operation disappears. Victims often don't realize they've been conned until it's too late, because the scammers know how to sound confident and legitimate on the phone. Front-running is a sneaky scam carried out by brokers and traders who have access to sensitive information about upcoming trades. For example, if a broker knows a large client is about to place a massive buy order, they might buy shares for themselves first. When the client's order goes through, the stock price rises, and the broker sells at a profit. This isn't just unfair, it's a betrayal of trust. Clients expect their brokers to act in their best interest, not to exploit them. In recent years, regulators have caught firms using algorithms to front-run trades by milliseconds, profiting from high-frequency strategies. Even tiny price moves can generate huge profits when repeated thousands of times per day. Churning accounts. Not every scam is about manipulating stocks directly. Some scammers exploit investors through excessive trading, known as churning. This happens when a broker buys and sells frequently in a client's account, not to benefit the client but to rack up commissions. The activity creates the illusion of active management, but in reality, the investor's account often suffers from unnecessary fees and underperformance. For an investor, it's difficult to spot because it looks like the broker is working hard. But if the trades don't match the client's goals or risk tolerance, it's a red flag. Churning is essentially a slow bleed of an investor's wealth, and regulators treat it as a serious breach of fiduciary duty. Fake companies and shell games. Perhaps the most brazen scam of all is when fraudsters create entire fake companies or use shell corporations to sell stock in businesses that don't exist. On paper, the company looks legitimate. It has a flashy website, impressive executives, and glowing press releases. But behind the curtain, there's no real business, no products, and no revenue. Investors get lured in with promises of huge growth, often in trendy industries like biotech, mining, or technology. Once enough money flows in, the scammers cash out and disappear, leaving investors with worthless shares. Some of the biggest financial scandals in history, like Enron, also show how even large, seemingly legitimate companies can manipulate financial statements and mislead investors. In either case, the end result is the same. Investors are left holding paper that isn't worth anything,